My name is Matt Russell from Daily FX Education, and this is moving from stock trading to Forex trading. And I've been an FXCM since 2004. I've been trading since 1998. From 1998 to 2004, I traded equities and equity options, day traded also. And obviously since I started working at FXCM, been trading currencies since 2004. So this presentation is a transition that I personally went through, and I'm sure many of you here today, with the name of the title, were attracted to it. You're thinking about going through this process, or maybe you're going through this process now. So that's what I'm going to speak about in terms of the topics here. So the first thing I wanted to bring up here is the risk disclaimer. And obviously this is a risky market. And if you could take a few moments to read the risk disclaimer. And one of the big things that I think about in terms of risk is always make sure that you're using risk capital. And risk capital is defined by money that you can afford to lose. And in other words, money that's not going to affect your lifestyle in any way, shape, or form. So in other words, we should not be trading our rent money or hoping that the euro dollar goes up 75 pips so we can pay our electric bill and things like that. And if you're in that situation, get yourself out of that situation. It's not appropriate, and have an account size that's appropriate to your personal risk parameters. So again, speaking the difference here between the stock market and the currency market. Now, in my opinion, what always attracted me to the currency market, it always appeared to be, and it is, more sophisticated. It's more real in terms of what drives, and this is sort of like an underlying theme, but what drives the stock market is more, I would say, it's a little more like spirits. It sort of guide the stock market. It really doesn't matter like the value of a stock. You can have the best stock in the world, the best company in the world, but if all the other stocks are going down, your stock's going down too. Currency markets, it's more linear. What is driving exchange rates is actual money that's flowing from one economy to the other, whether that be in trade flows, which is, let's say, the US buying Japanese goods, or in capital flows, let's say German investors investing in the US stock market. Those are real forces that are pushing prices in one direction or the other. And one of the great things also about currency markets is that they trend better than any other market. And the reason is related to that fact, to the flows, because once those things get into place, once foreign investments start flowing, let's say, into the US stock market, those trends are very hard to sort of stop. They persist, sort of like a super tanker on the ocean. You can cut the power, the thing's going to drift for miles and miles and miles because it's so heavy, the weight behind it. And that's why the currency markets trend stronger than any other. So basically what we're going to talk about today, the key differences between the two markets. The first is volume, and that's a point that a lot of newer traders, it's a question I get a lot, and that's going to be the first thing that I'm going to speak about. The second is the close, or the lack thereof, in the FX market. And the third, and I would say they're all important, but probably technical analysis is more that's going to affect your day-to-day life as a trader. And then leverage and the transition from going from an investor to a trader. Because I think that a lot of you out there, in terms of your transition, it might be, we have a lot of, at least the clients I've encountered, it could be different here, but have been more in the stock market, but it's a little more passive. You might have a broker, you might have a 401k, and so you're not used to self-directed accounts, and that's a big transition as well. And certainly if you have any questions, please feel free to stop me. Any questions about any topic, that's totally fine. So volume in stocks. Now, volume, it's very important with individual stocks and indices. And again, that's the major difference in terms of this market, the way that traders actually watch volume. And fund managers are very active between 3 and 4 p.m. Eastern time as the market's closing. And therefore, closing prices are more relevant compared to foreign exchange. Now, when I make that statement, That's not to say that the closing price is insignificant in foreign exchange. It just means that, as I was speaking about before, the gentleman asked about the possibility of a trader moving around the FX market, and I responded that that really doesn't happen. But it can happen in the stock market. And what can happen intraday is, again, a large order can come through, a market maker has to fill that order, and it's not manipulation, but the simple act of him placing that order can drop a stock a point, 2 points, 3 points, depending on the liquidity, depending obviously on the size of the order. And what might happen in a situation like that, one fund manager might have to sell, and then another fund manager who needs to buy between 3 and 4 p.m. will look at the depressed price and go in and buy. So what you have during that day is you have a long candle wick to the downside, and prices snapping back up higher. So this price action, it's really not important, like in terms of what happened intraday. It's where things close. And that's the major difference in terms of stocks compared to FX, because in FX, and certainly when I get to FX here, as a general rule, we can assume a large amount of volume with any price move. And if the volume is low, in foreign exchange, the market simply does not move. So again, the volume aspect is a question I get a lot. And typically, I'll explain what I just explained, and then a client will come back to me and say, okay, that's great, Matt, but how do I see the volume? Like, how do I use the volume? Like, they just, and it took me a long time, too, to sort of get past that. I didn't understand how traders could not look at volume coming from the stock market. And so the example that I use is Microsoft. So let's say Microsoft moved from $15 to $25 over the course of a year. Now, if that was the case, if your broker called you up, let's say you were traveling in the Far East or something, and you come back, you made 10 points in Microsoft, you had a big position, you wouldn't ask what was the volume. Who cares? Obviously, the volume was great. It was over the course of a year. It moved from 15 to 25. The same amount of money that it takes to move Microsoft from 15 to 25 is the same amount of money that it takes over the course of a year, is the same amount of money that it takes to move like the euro dollar a couple of hundred pips over a few days. So that's the sort of analogy that I like to give in terms of understanding the volume. It's not as though volume is insignificant in foreign exchange. It's just that it's so massive. It's such a fixed part of the market that's why we don't look at it as an indicator. The other reason is that it's hard to quantify because it's not a centralized exchange. In terms of the equity markets, all the markets either have to come through the NASDAQ or the New York Stock Exchange, and it's easy to count each individual share that goes through them, and they count it down to the individual share. In foreign exchange, it's a little harder to do that because things are going on around, there are orders over here, large orders over there, so it's an important aspect to understand. And again, if there are any questions, please feel free to ask. So one of the other things I wanted to touch on here, the close. Obviously, those of you with experience in the U.S. stock market, opens at 9:30 Eastern Time, closes at 4 p.m. And the FX market trades continuously, continuously during the week, from Sunday at 5:15 until Friday at 4 p.m. So obviously that's a large difference in terms of market timing and when the market is open. And one of the good things about that, and my colleague James Stanley yesterday was speaking about an example such as Apple. If Apple comes out after the bell at 4:03 Eastern, they announce a new product or something like that, or let's say they miss earnings, it could go either way, up or down. And you're an investor, there's nothing you can really do. I mean, maybe if you have an account that you trade after hours or something like that, but the liquidity is not that good at that time, there's nothing really you can do. The next morning you want to buy Apple, it's already going to spike up or spike down at a certain level. There's no way to get in. Whereas in the FX market, because it's open continuously, the market reacts to news, it digests that news, and it prints that news and discounts that news instantaneously. So it's a major advantage in terms of timing, in terms of being in the market. Now, there are also psychological impacts in terms of the market being open 24 hours a day, Monday, Sunday afternoon through Friday afternoon, and I know for me and for a lot of people who are introduced to this market and sort of, love this market like I do, it's a little hard to get used to, and sometimes you might find yourself watching the screen a lot, and I'm sure some of you can identify with that. So that's another thing to get used to in terms of the difference in the way the market changes, and it's something that I personally had to get used to. I sort of missed a little bit in terms of the equity markets being able to, at 4 o'clock, shut down. And then also day trading. So when is day trading? That's the thing. And like I said, one of the things I missed about the equity markets is being able at 4 o'clock to shut down and just completely detach from the market. And it's a little bit harder to do that in foreign exchange. So it's, again, making that transition, finding out what works for you in terms of how to sort of set your life. What times to trade. Everybody's a little bit different. I'm immersed in the market a lot. Obviously, I work at FXCM, so at least during my shift, I know I'm going to be immersed in the market. And then even when I'm up during the day, like my computers are always running, but I've learned to sort of strike that balance. And it took a little while to do that, but eventually I did. So that's another, sort of process to get through. So in terms of technical analysis, which again, like a lot of stuff I spoke about so far is sort of like an introduction, if you will, but I think technical analysis is the most important, certainly when you get more experience, is the most important difference. And again, one of the big things is the closing price. And if there's more volume, which there is obviously in foreign exchange, as I mentioned, there are more sample sizes. And it's like any science experiment. The more sample sizes you have, the more statistically significant your results are. And therefore, the more likely, in my opinion, foreign exchange is going to adhere to technical analysis. And that's what I was mentioning before. In terms of FX, every price point is significant. And that's sort of the key of what I want to speak about today. If there's one thing you could take away, this is it in terms of the difference. In FX, every price point is significant. Because what that also gives us is a good reference point in terms of setting up trades, which I'm going to talk about in a second here. And that's using support and resistance. Those of you who are familiar with my live presentations each night, I do speak at 9 p.m. Eastern on Daily FX Plus. You'll know that support and resistance is my favorite method of technical analysis, and it's one of the best ways to illustrate the differences between stocks and foreign exchange. Again, is how support and resistance lines are applied in both markets. In terms of stocks, because the close is the most important thing, a lot of traders or analysts will use the body when drawing support and resistance lines. And let me bring up the chart here because I'm just speaking, and obviously you want to see some charts, but this is what I mean in terms of starting a support line at the body and then sort of putting the line and what I don't like about using the body when I'm drawing support and resistance lines, because I often get that question in terms of, hey Matt, how do you draw your support resistance line? Should I use the body? Should I use the candle wick? Where should I do it? I'm a little confused. And this is a great example as to why I personally use the wicks in terms of drawing my support and resistance line in foreign exchange. Again, because in the stock market, the example I was giving before, let's say there's a lot of selling here. So at one point this was a large red candle. That might have just been one random order that came in. And then towards the end of a day, another fund manager came in and moved the stock right back higher. So that's why, again, the close is so much more important. Now, in terms of foreign exchange, every price point is significant. So in terms of drawing our support and resistance lines, we go ahead and we can use the wicks in terms of drawing those lines. Because even here, this long wick to the upside, when prices went up there, things are liquid up there. There are orders on either side. And so when prices get up there and reverse, yeah, maybe another larger order came in and knocked prices down. But that is a significant price point. The fact that the foreign exchange market can get to that level automatically assumes that there's a large amount of volume behind it to get to that level. The same amount of volume also pushed it down, but again, that's what makes it a significant price point. For the most part, I'm using daily charts and in terms of my analysis. And when I say the close in the FX market, it's considered 5 p.m. Eastern, and that's because New York is the last major financial center where the sun sets. It has to do with the international date line. It's the last place that the sun sets on that particular day, and that's just how it is. And so that's why we use the 5 p.m. close here in New York for each day. And again, in a sense, it really doesn't matter. Like again, I don't want to say like it doesn't matter where it closes, but that reference point is not as important. Like this, where it closes, like this price point is just as important as where it closes. And that's, again, the key difference. But again, the key point is that it's not just some random order that came in and knocked it around. It's the FX market is so thick, the books are so thick, that it takes significant pressure to get it there. And so the key point, again, to extract from this is in applying support and resistance lines. When we go back to the stock chart, one of the things I don't like about using the body, because you can draw support and resistance lines that use the body, and you can see how maybe in the past they would have worked, and they might also set up a trade or two for you that might work. The issue is, it's so much more easy to have your analysis be subjective and what I call fitting your lines. So you can look at any currency pair you want and bring up the chart, and if you start using the body, you'll be able to find a support or resistance line that sort of fits into your particular trade idea. And in my opinion, that's a dangerous, dangerous thing. Whereas in the FX market, you can use the wicks, which are significant price points, and that's where that line is. There's no debate as to how exactly to draw that line. Now again, you can use the body in FX, but personally I just wouldn't do that. And sometimes, you know, not to confuse you a little bit, sometimes I do allow a little bit of wick penetration. Certainly if there were, like, let's say 4 points of resistance on this chart, and we have a little wick that goes up on top, but that's a little bit more subjective. But the point is, I'm a lot less likely to fit lines in foreign exchange than I would be in the stock market. And that's the key difference in terms of technical analysis and applying support and resistance lines. Now, so leverage. And one of the most important aspects of the transition is the higher amount of leverage in FX compared to equities. And I honestly, when I created this slide, I didn't think of it as a benefit. I thought of it as just a fact of the market. And certainly understand that that leverage, you know, it can increase wins or profits, but it certainly can increase losses. And I'm always looking at the risk side of things first. So it's getting used to that amount of leverage. Now, normally if you're a pattern day trader in the stock market, you can get up to 1 to 4 leverage or 4 to 1 leverage. And now in FX, 50 to 1. It used to be 200 to 1. In some instances in the U.S., you were able to get 400 to 1, which is an obscene amount of leverage. So 50 to 1, even though some of you might be a little disappointed that we came down to 50, that's at the end of the day, it's for your own benefit to sort of decrease that amount of leverage. And as a general rule, and again, this is just a general rule, and I believe it's true in all markets, and it's just my opinion, but the more successful traders are using less leverage. And that's the rule. And I would say that that's across the board. Certainly there are instances that, you know, maybe a smaller account can move up higher using the leverage and sort of adding on to that, but those instances are few and far between. There are a lot of more examples on the other side. So it's getting used to that leverage. And so what that means is applying proper risk management. And 2 trading rules that I have, and this is something that I speak about in a lot of my presentations, and I will speak about it this weekend during I think 2 other of my presentations as well, are my 2 trading rules. And one of the things in terms of rules, in my opinion, like having trading rules, having a list of, let's say, 20 or 30 or 15 trading rules, whatever it is, if you have, let's say 15, if you have a list of 15 rules, I'm never going to do this, I'm always going to do this, I'm going to do this, I'm going to do that, and you break rule number 7, you kind of say, well, rule number 7, you know, maybe this situation's a little bit different, I'm not going to do rule number 7. At that point, all your 15 rules are meaningless. You can't stick with them. So what I would ask all of you, and this again is a function of the leverage difference, is these are my 2 rules, but try and pick 1 or 2 or 3 rules that you can always adhere to. And maybe they might be a little bit general at first, and certainly in the education department, me or my colleagues can help you with that in terms of, you know, solidifying them or cementing exactly what they can be. But try and think of a few simple rules that you can always adhere to. And my 2 rules, I will never lose more than a certain number of pips or dollar amount on any single trade idea. That's usually somewhere between 50 and 75 pips. And my second rule is, and it's a little confusing, but I'll explain it here. I was stopped out, and that's sort of the point. I was stopped out because, and the point is with this sentence, is to always have this sentence completed before you entered the trade. Usually the way I complete that sentence, I was stopped out because a clear technical level was violated. And not to be morbid or not to have negative thinking in terms of my trading, but if you fully understand and comprehend that when you enter this trade you can lose, that's when you learn to manage your risk properly. Professional traders view the market through the lens of risk. And one of the ways to sort of manifest that is with a sentence such as that. I was stopped out because a clear technical level was violated. I mean, in terms of daily charts, if you listen to my presentations, usually I'd say between 2 and 4 trades a week. In terms, yeah. And also I'm usually only making 1 trade at a time. So that's the other thing. And that's also personally what I do. That's just the way, and again, that's what I do. Like, you don't have to do that, but that's also a way for me to sort of manage my own risk, understand my own, in terms of the psychological impacts of trading and how to manage that and keep my emotions under control, keep my account under control. That's what I've learned works for me, 1 trade at a time. Because if I start trading, if I have 2 trades at a time or 3 trades at a time, and all 3 of them go down at the same time and I lose on those 3 trades, then that affects my confidence. So that's, and again, that's just what I do personally. You have to learn how your own mind sort of functions, and similar to those trading rules. Like, those are my 2 trading rules that I know I can always adhere to, but each individual might be a little bit different. And you know, you can always check it with us in terms of if the rules might just be in outer space or something like that, then yeah, we'd say maybe that's not a good rule. So I'm at least personally trying to make 3 times the amount I'm risking. But I would say anything for anybody, for the general rule should be at least 1 to 2. So, but as a general rule, like in this case on a daily chart, you know, that's the minimum. A lot of my trades, like I think the dollar CAD trade I was just in, we entered, I only had a 25 pip stop loss, a 25 pip stop on that trade. And we ended up making like 100 pips, so it was 1 to 4. And at one point it was up 150 pips, so that's a 6 to 1, a 1 to 6 risk to reward ratio. And that's the thing, on daily charts, you can have extremely favorable risk to reward ratios. And it's one of the reasons that I love daily charts, but you have to be patient and wait for those trading opportunities. And I'm here to tell you that those trading opportunities will come. And one of the ways to ensure that that happens is sort of increase the amount of pairs that you're looking at. There are a lot of currency pairs out there, over 50 pairs to choose from. Now, maybe some of them you're not going to trade all 50. But I'd say at least be looking at 15, 20 charts that you can sort of go through and say, okay, this is not good. And also using price alerts, like looking at chart, like this chart right here. Like the process I'd go through on this chart is waiting for prices to come up to this resistance line. So looking at this chart, imagine this is the current time in the market. I might set a price alert at 124, let's call it 124.75 or something like that. 124.80, 124.90. So, and then boom, next chart. Well, you know, that's it. I'm not sort of jumping in. So again, the 2 trading rules and also the 5% rule. I'll never risk more than 5% of my account equity on any single trade idea. It's also one of the reasons why I stick to one trade at a time, to make sure I don't have those 3 losses at the same time. Also, there are correlations between currency pairs. So there are some obvious correlations between currency pairs, but sometimes they're not as obvious. And so I can actually be losing on 2 trades at the same time because all of a sudden there's this different correlation, because just depending on what the news is. And honestly, it's a little like exhausting to keep track of all that stuff. So to keep, in terms of keeping it simple, I'm a firm believer in keeping it simple. That's why those 2 or 3 rules. And then as you sort of mature as a trader, your analysis will improve. More of the artist in you will come out in terms of your trading. But at first, I would say just keep it simple. And so here we go. From investor to trader, many of you are going through this process here. The most common transition when introduced to the FX market, and adjusting to the self-directed account. Many of you, again, might have been what I call passive investors in the stock market, but here you come to FX, and here you go. This is good luck kind of thing, but that's not how it is, because honestly here, and this is, I wanted to show you the news and research site here at FXCM, which is Daily FX, and I would recommend that everybody, I'm sure a lot of you are familiar with Daily FX, and also Daily FX Plus. The SSI, or Speculative Sentiment Index, is something that I highly recommend, particularly for newer traders, in terms of helping you trade in the direction of both the overall trend, and also, because what the SSI is, it shows retail positioning here at FXCM, and a lot of times traders look at, let's say, the dollar Swiss, since it was coming down from 117 when it went to 105, when it went to parity 1, when it went to 95, and a lot of traders just say it has to go up. Buying at 95, it has to go back up. Buying at 90, it has to go back up. Buying at 85, it has to go back up. And a lot of traders lost money, obviously, with that downtrend that just persisted for seemingly forever. And how low is it going to go? And then finally, probably in the 70s, a lot of them said, okay, I give up, and now prices went back up. But if you were following that SSI was giving a sell signal that entire time since the dollar Swiss broke beneath that 110 figure. And so that's one of the tools, and it's just an example of one of the tools that we have here at FXCM that can help to sort of get over some of the tendencies of newer traders, which is to look at something and say, okay, now it's gone down, it has to go up. But again, this market's a little bit different. And again, the SSI is something that I highly recommend. And secondly, and not just because it's what I do, but the new course here at Daily FX Plus, we do have live presentations 3 to 4 times a day, Monday through Friday. I speak at 9 p.m. Eastern, Monday through Thursday. And then James Stanley is after me at 11 p.m. I lead into him at 11 p.m. Eastern. I'm a lot longer term in focus. He's a little more shorter term in focus. And if you have a live account at FXCM, again, you have full access to Daily FX Plus and the webinars. And that, again, it's a great tool. We also have the on-demand video course, which speaks about a lot of all these, about technical analysis. We have 2 long videos for each topic, and topics such as stochastic, Bollinger Bands, MACD, also the SSI. And we also have instructor takes, which is a situation like this where I'm speaking in front of a whiteboard, and we speak about some of the individual, like the RSI, the stochastic, or something like that. So use the free resources that are here at FXCM. You're not on your own. Ask questions, be patient. Don't be in a rush at all in terms of, first of all, making the transition, and if you're new to the market's always going to be here. Learn what you're doing, and again, we have the resources. And on dailyfx.com, for example, a lot of newer traders want to trade the NFP, and it's something that I wouldn't recommend for newer traders, but we do have live analyst coverage of the NFP release at 8, and a lot of the major economic news releases at 8:30 a.m. Eastern, where you have an analyst sort of walking you through that news release. So it's very important to have somebody sort of in your corner when you're going through it to view the market release through the lens of an analyst. And it's one of those things that I spoke about often, is that why I love foreign exchange is, what I loved about options in the equity markets was the amount of leverage that I can get. And what foreign exchange offers is all the same amount of leverage, but in a cash market. Options, you're dealing with time decay, and that's usually the killer in terms of options. Any option is the time decay, and that's where the banks make their money in terms of pricing those options. The time premium is baked in there, and the banks make money because time passes. That's a pretty good trade. So personally, I trade the spot market, and I do trade the spot market. If you have some complex option strategies or something like that, if you can maybe identify some inefficiencies, options that are mispriced and something like that, maybe. But in terms of using, like, I would just trade the spot market because you have 50-to-1 leverage. There's really no point to trade those options. Certainly, if you're a corporation or something like that, and you have a specific need to protect yourself as a hedge or something as a company, then maybe an option might be a better, or maybe a forward contract or something like that. But all those options, that's the thing. All the options and forwards and future prices are they're derivatives, they're derived from the source, which is the FX market, the cash market, the underlying market. So I might as well trade that market. It's available to us now. It used to not be available to retail investors. It used to have at least, I forget what the amounts were, but at least $1 million to trade in the FX market. And then even if you did, you were so sort of blind to what the actual market was that it was easy for, and again, this is probably in the 80s and maybe early 90s, there wasn't as much transparency. If you were, let's say, a wealthy investor and you had a like a brokerage account, your broker might trade FX for you, but you wouldn't really see the market or anything like that. That's sort of the niche that FXCM provides, is retail access to the foreign exchange market. So might as well take advantage of that. But I wouldn't, I understand, I used to love options for that reason. I used options as just leveraged equity positions. But again, FX market, in my opinion, it's all the benefits of options in a cash market. And I don't have to pay commission. I mean, I do pay commission through the spread, but the spreads are relatively tight, and that's really the only cost to me. And I don't have to deal with the time decay. So once again, my name is Matt Russell from Daily FX Education. I want to thank you all for listening. Enjoy the rest of this weekend. I hope you enjoy all the rest of your presentations. And thank you all for listening. So thank you.